You're listening to Indications by the Conference Board.
Hello, welcome to Indications. I'm Elizabeth Crofoot, Senior Economist at the Conference Board. Today we're beginning a monthly podcast series entitled the U.S. Labor Market Roundup, where our labor market experts will give their reading of the latest jobs report released by the Bureau of Labor Statistics. Then we'll follow that up with a discussion of a special labor market topic. In this first episode, we'll discuss the June's job report, and in light of all the social dialogue that has really been prevalent right now around the country, we're going to discuss how COVID-19 is impacting U.S. workers and households. So today I have with me Gad Levanon, head of our Labor Markets Institute. Gad is a foremost expert on U.S. labor markets and of forecasting the U.S. economy. He is an avid blogger on labor market topics and is a regular contributor to Forbes. And I'm also joined by Frank Steemers, economist at the Conference Board. Frank is one of our primary researchers focusing on U.S. and global labor markets and is the main author of a recent report on human capital responses to COVID-19. Gad and Frank, thank you for joining me today.
Thank you, Elizabeth. Pleasure to be here.
Yeah, thank you, Elizabeth.
Great. So before we really dive into the June's jobs report, I want to backpedal a little bit to really give some context as to where we are today and how we got here. So if we think back to February, which seems like ages ago, we had an unemployment rate of 3.5%, really historic low. The labor market was really tight. Employers were having a hard time recruiting and retaining workers. It was really a complete 180 turnaround that we saw from that point until today. And that was really induced by the pandemic. So we saw most of that impact from the pandemic begin in March and April. So during that time, that's when we really saw the height of business closures as governments started their measures to contain the virus and really close down economies for that purpose. We saw a combined 25 million jobs lost over March and April. And then the unemployment rate peaked so far at 14.7% in April. It came down a little bit to 13.3% in May. And in the latest jobs report, we are now seeing an 11.1% unemployment rate. And even though we did see some job losses earlier on, in May and June, we actually saw some job gains as certain economies, especially in the South, started to reopen. Some containment measures started to ease up more. So restaurants, stores, we started to see more economic activity as people started to re-engage in their local economy. So in May, we saw an increase of about 3.8 million jobs. In June, 4.9 million jobs. So there is a little bit of a bounce back, but we've only recovered about a third of the jobs that we total in May and June that we lost in March and April. And again, to put this more in perspective, we are still at 11.1% unemployment. This is still historically high. It's still higher than the 10% unemployment rate we saw during the worst part of the Great Recession in 2009. So that's where we are today, how we got to where we are. And I have Gad and Frank here today to really put all this more into perspective as to what we should be paying attention to as the labor market unfolds over the next few months. So, Gad, what should we be looking at, in this jobs report in particular?
Yeah, I think maybe the most important thing is what's not in the jobs report, and what's not is what happened in recent weeks, because the June's jobs report actually reports the number of workers or jobs in the week of the 12th of the month. So anything that happened since that week is not reflected in the numbers yet. And what happened since then is an escalation in the spreading of COVID and states moving from reopening their economies to in some case not opening them further, and in other cases continue starting to shut down things that were open before. So unfortunately, this could mean that we won't see much more job growth, if at all, in the next several months, because on top of that, on top of the not reopening further, we know from the unemployment, initial unemployment claims statistics, that there are still huge number of layoffs going across many industries. So we think that the grim reality is that we are likely to be in the unemployment range of 11 to 15% for the foreseeable future.
Frank, do you have any thoughts about that?
Yeah, I think Gad makes a good point, but also puts into perspective on how difficult it is to forecast with such a pandemic, when there are so many moving parts. So a month ago, we were still expecting that the unemployment rate would just continue to come down as states were opening up. But as we're now seeing with cases surging across many states, then of course, when businesses cannot open up, they cannot bring back their furloughed workers, and some businesses will continue with laying off people. So you see that also we need to shift into a different scenario where we're not looking anymore at an unemployment rate that will just continue to decline, but as Gad was explaining, that might now plateau or even move up, depending on, of course, what happens to the states' reopenings.
Mm-hmm. My feeling about this is that we've seen employers really do the easy rehirings where they're reaching back to hire employees that were relatively more attached to their employers than other workers. So any continued job gains, I think, are going to be slower and harder to really implement. And just to, add a little color here, back in April and May, there was this Washington Post poll where 80% of laid off workers said that they expected to be rehired by their former employer. But we're really not seeing that. There's still an increase in the number of permanent layoffs. So this is not the reality of what people were expecting before. This is definitely more of a drawn, long out process. And it just really highlights how any recovery in the labor market is going to take a lot longer than anybody expected, especially as we start to reclose the economy. Are there, Frank, can you tell me a little bit more about really the industries or occupations that we might be seeing the most impacts?
Right. We know, of course, that it's the job losses are not equally shared across industries, and especially in April we saw very huge declines in employment, and most visibly in, of course, the industries where you expected, or where most people had expected it, and that are the industries most impacted by social distancing. So, for example, performing arts, spectator sports, accommodation, amusement, museums. They lost about 60 to or 50% of their jobs compared to February. Now, interestingly, of course, you already mentioned it, that in May and also in June, we actually had the reversal, so an increase in jobs. And we see that it is also happening across many industries, but not all industries. So, for example, we see for a 2 month period already quite a bounce back in amusement. But only a little bit in accommodation. And when you look at spectator sports and performing arts, there's actually no bounce back yet. So there, the employment losses are still there, and the recovery has not yet started. If we look at air transportation, job losses have just continued, even though overall there was an increase in May and June. In food services, drinking places, so that are the bars and restaurants, there, of course, we have seen actually quite a bounce back. But we also know that now with the states maybe not opening up, and we know in New York, for example, some of the opening phases are now on pause. So that means that indoor dining is still not possible. So that in the coming months, there might not be this recovery in bars and restaurant employment might not continue. And so Besides that, I think one very interesting industry that is offices of dentists. They last up to April 50 to 60% of their employment, but they almost entirely bounce back already. So a lot of offices already open up again, and they're now about 10% down compared to February. But of course, going forward and looking ahead, I think it is still a question which industries will just continue to recover. We see manufacturing, construction, which have recovered a little bit, but we often know that in normal recessions, job losses are quite severe in these industries. So that might very well be that over the coming months, we may see actually declines in jobs in these more cyclical industries. And then maybe a last point where the very few industries where we see an increase have mostly to do with online shopping and with people now staying at home. So we see that in supercenters, warehouse clubs, for couriers, messengers, but also food and beverage stores. There has actually been an increase in employment compared to February.
Yeah, and it's really interesting to see what has happened to those industries that have really benefited from the current situation. I mean, we hate to, this is definitely a dire situation for most businesses and employees. But on the other hand, you have companies like Amazon, for example, that have been hiring, or even CVS, or other pharmacies. Home Depot, for example, also as people are staying home and focusing on what they can do around the house, those types of industries have really seen a surge and didn't see job losses, if at all. So it'll be interesting to see what happens to these industries as well, how dominant they become in the future as this pandemic continues. Gad, do you have any thoughts about this?
Well, I think one, if you look at occupations, I think one occupation that we're already seeing some significant job losses, but probably permanent job losses, is a kind of office and administrative support workers, the clerical routine office jobs, because those jobs were the ones that were most automated in the past decade, much more than manufacturing jobs. And we think that there is still a lot of room for digital transformation to automate more jobs there. And a lot of companies are now in a survival mode, or in a period where they see profits drop significantly, and they are desperate to make labor cost cuts. And I think a lot of those jobs will be permanently replaced by technology in this recession.
Mm-hmm. I'm also wondering about the temporary help services industry. So staffing agencies, they also saw a very significant drop in employment. And just recently, in April and June, they have started to rehire. What does that indicate? How can we look at that? And, is that giving us hope for the future?
I think a lot of the temporary help recovery was simply because a lot of businesses were shut down, and some of them, when they opened up, they brought back their temp help workers as well. But all in all, this industry is now down almost 30% compared to February, and this industry is maybe the most cyclical historically. So meaning that during the recessions, the temp help industry is the most hard hit, and I expect that to be the case this time as well.
Mm-hmm. Yeah, and as we continue to see job losses across all these industries, it's really giving us a sense that it's not just targeted to those industries that are most impacted by social distancing, but it's impacting the entire economy. So it's very broad in that sense. And for that reason, we're seeing unemployment rates really skyrocket. Like I mentioned, 11.1%, not in June, not the highest we've seen during this time, but still double digits higher than in the last recession. But there might actually be more slack in the labor market than what that suggests. Gad, can you explain that a little bit?
Yeah, I think typically periods of high unemployment rate are also periods where people find it very difficult to find a job, and where employers find it easy to hire qualified workers. But now we have the biggest disconnect ever. So we have historically high unemployment rate, but when we look at measures of how difficult it is to find a job from our consumer confidence survey and from other surveys, for example, the National Federation of Independent Business suggests that they measure how difficult it is to find qualified workers. So those other surveys are not that extreme at this point. So they are showing that things have changed since February. But for example, if you compare to the Great Recession, it's still much easier to find a job now, and it is more difficult to find qualified workers compared to the Great Recession, even though the unemployment rate is higher, much higher than it was during the Great Recession. And I think the main reason for that is a lot of people who are officially counted as unemployed, they are not, in some cases, they are not looking for a job at all. And in other cases, they may have to look for a job to get the unemployment benefits, but they're not seriously looking for a job. And as a result, the unemployment rate overstates how much slack there is in the labor market.
Yeah, as you mentioned, some people may be not looking for a job because of the specific situation, which is very unique right now. They're either too scared of becoming infected by the virus, so they don't want to go out and put themselves in that position by looking for a new job. We also have very generous unemployment insurance benefits right now. So many may be content with collecting that support right now and staying home. And of course, we have schools being closed and summer programs now closed. So parents are still without childcare options in many parts of the country. So that is also another impediment to going back to the labor market. And the other measures that you were indicating in terms of slack in the labor market, I think that it really points out how those types of measures and even the official unemployment rate are not giving us a complete picture of what the labor market looks like, because they're not intended to capture these extreme events where there are people who are not looking for a job because of these other situations. Frank, what other measures can we be looking at instead to give us a better sense of what the true picture is right now in the labor market?
Yeah, I think like recently or over the last 2 months, more and more people are now already talking about what some refer to as the true unemployment rate. As the BLS has pointed out themselves, there may have been some misclassifications. So people, as they explained, people were classified, or some people as employed but not at work. And these people probably should have been classified as being unemployed. So for the most recent job report, that would have meant that we didn't have an 11.1% unemployment rate, but actually a 12.3% unemployment rate. So that is already one measure that more people are now already tracking. Besides that, and that is a measure we often look at, that is what we call the broader measure of unemployment. That is called the U6. So there you don't only look at those people that are unemployed, but also the people who are marginally attached to the labor force. So people that are not actively looking for work, but people that still want to find or would be willing to work. And it also takes into account people that are now working part-time for economic reasons. So we know that, of course, employers have started to cut hours fighting job losses. But it means that some people now have to work involuntarily part-time. So if you also take these people into account, you get a better perspective of how many people would still be willing to either work more hours or willing to find a job. And then before I forget, and the last one is just sometimes it's a little bit difficult to understand who is exactly classified as somebody who is unemployed. You need to be actively looking for work. So therefore, we sometimes also just check, do you have a job, yes or no? And then we look at the ratio of employment in the population, so the employment population ratio.
Yeah, I think, there's a lot of confusion out there right now as to how could it be that there's this true unemployment rate versus the official unemployment rate that BLS has been reporting. And it seems that, there were a lot of workers that were temporarily furloughed, but it's not like they got an official pink slip that said you are now officially in the furlough category, and this is how you should respond to the survey. They're very different treatments and different ways that employers can, put off their workers for a time until demand comes back. So I think that's part of the confusion around this is people themselves don't know how to respond, and employers also are not sure when they're going to be able to reopen. So that's one reason why we're seeing a lot of uncertainty in a measure that otherwise been uh, has been able to signal the labor market very well. Another aspect of how impactful COVID-19 has been on the labor market is on wages. You mentioned, Frank, that employers are cutting hours. That's another way to cut back on spending, but they're also cutting wages in order to survive this period where they're not taking in any revenue. Gad, what are some of the implications for wages that we're seeing now and then potentially in the next few months?
Yeah, I think the outlook for wages is very gloomy. We mentioned before that a lot of people who are currently unemployed are not actively looking for a job or seriously looking for a job, but that's likely to change. A lot of people will realize that that they thought that they are on temporary layoffs, but they're actually on permanent layoffs, and that will make them look for another job. And unfortunately, or unfortunate or not unfortunate, depends on where you're coming from, but the generosity of the unemployment benefits is likely to decline in the second half of the year. So more of those people who are getting them would start looking for a job. So we think that within a few months or quarters, the unemployment rate will reflect the true amount of slack in the labor market, and will have the expected impact on wages. And the unemployment rate, which is, or the labor market slack, is perhaps the most important determinant of wage growth. Another important determinant is inflation, and which is historically low and gives companies less need to compensate for an increase in cost of living. And so the combination of those two things may lead us to a period with the slowest wage growth in recorded history. I think we could see wages go well below 2% for a prolonged period of time.
Yeah, and there's been a lot of fluctuation right now in the average hourly earnings that are reported in the jobs report. We had some acceleration earlier on in April and May, and now or in March and April, and then May and June, as we started to increase the number of jobs, we also saw average hourly earnings decrease. And that's really a reflection of those lower paid workers that initially lost their jobs and increased the average. And now as we're picking those employees back up, it's now inflating average hourly earnings. So it's really not reflective. That data point of average hourly earnings is not really reflective right now of the true movement of wages that we should expect in the future. Frank, I know that you've had a lot of experience as you were writing your report on some of the human capital responses to COVID-19. We heard about how some companies were adjusting their compensation and wages in response to COVID. Can you share some of that information with us?
Yeah. So I think from our survey, while you were just explaining, it's difficult to already see or to already accurately interpret what is happening to wages because of all these distributional or compositional changes which affect the average hourly earnings. But from our wage or from our survey, we actually asked companies or HR leaders what actions they were taking or were planning to take. And we also asked about deferring pay increases or bonuses, and if they were cutting bonuses or cutting salaries or wages. And from that survey, we found that 40% already had or was planning to defer pay increases or bonuses. 30% was already had or was planning to cut bonuses, and 22% already had cut salaries and wages, or they were planning to do so in the next 3 months. In our case, it was May to July. So I think that already indicates that we are very likely going to see lower wages and salaries, and therefore lower wages and salary growth rates over the coming months.
Well, I think this is a good point for us to stop for a quick break for some announcements from the conference board. We'll be right back.
Can you, your team, or your company benefit from insights such as the ones provided in this podcast? They are immediately available when you join the conference board, a membership-based think tank that delivers trusted insights for what's ahead. Reaching across industries and geographies, we bring together our noted experts, senior executives from the world's largest companies, and nonpartisan practical research to help you address your most important business issues. Our membership packages are tailored to your organization's unique needs and budget. To learn more about our offerings, go to www.conferenceboard.org and click Join on the top bar to connect with one of our product specialists.
We're back. This is Elizabeth Crofoot, Senior Economist at the Conference Board, and you're listening to Indications. We were just talking about the June jobs report with Gad Levanon and Frank Steemers, and we're going to shift a little bit now and really address the impact that we've been seeing of COVID-19 on U.S. workers and households. The move for social distancing and the necessary steps we've had to take to really contain the virus have had a disproportionate impact on certain demographic groups, especially the young, the less educated, minorities, and women. And, we want to talk about these specific trends and how we can expect these different groups of people to fare in the future, both in terms of their employment prospects, but also some of the government policies that have been put in place to support workers and households during this time. Frank, maybe you can start us off here and just give us a lay of the land. What are we seeing in terms of unemployment rates, and how is COVID-19 impacting different people differently?
Right. So let me talk a little bit about the differences that we see across demographic groups, because of course we know that the different demographic groups are not equally impacted. So we see especially large differences actually if we look, for example, at different age groups, education, race and ethnicity, but also differences between men and women. So to start with the different age groups, we have seen an especially strong increase in the unemployment rate for young workers, so those aged 16 and 24 years old. So there the unemployment rate is actually now just over 20% still. And comparing that to the group that is 25 years or older, there the unemployment rate is actually even half of that, so now at 9.7%. So we see that especially young people always have a lot of difficulties when a recession hits, because all of a sudden they have to compete with job seekers that have more experience. There are not a lot of job openings. So we also expect that it will take a longer time for these young people to get back into the labor market. When we look at educational attainment, we see especially high unemployment rates for those without a high school degree. It's just over 16%. For those with a high school degree, it's 12%. people with some college are have an unemployment rate of about 11%. But if we compare that to the group with the BA or higher, there the unemployment rate is actually just below 7%, so 6.9%. So we see that especially those with lower educational attainment are very much impacted and more impacted than those with the BA or above. So when we look at race and ethnicity, so in the first 2 months, we actually saw a very strong increase, the strongest increase in the Hispanic population. But there has actually over the last two months been quite a bounce back, where the unemployment rate for the Hispanic population is still very high. But there has been relatively a lot of improvement. If we look, for example, at the Black population, the unemployment rate is now 15.4%, and now actually the highest across all race and ethnicity groups. And there is a recovery, but not as fast as we have seen, for example, for the Hispanic population, where the unemployment rate is 14.5% now. By gender, the unemployment rate for women is slightly higher than for men, 11.7 versus 10.6%. And of course, this is very much influenced by the jobs these different demographic groups or the people in these demographic groups are working in. And the most impacted groups are, of course, working mostly in occupations most impacted by social distancing.
Gad, do you have any thoughts about sort of the disparate impact on these different age, education, and racial groups?
Yeah, I think one observation is that it's almost the mirror image of what we've seen in the years right before COVID, where the larger labor shortages in blue collar and manual services jobs actually made the people without a BA and minorities and young people, they made stronger gains in the labor market than more white educated people who are more in the professional and managerial positions that saw a much slower, for example, wage growth before the pandemic. So it's kind of almost a mirror image. The groups that did better before the pandemic in terms of improvement in the labor market situation are now seeing again a stronger deterioration.
Yeah, and Frank had also mentioned that there was a little bit of a bounce back in the unemployment rates in the last month or two, based on compared to what we had seen earlier in March and April for certain demographic groups. And that's partially also due because of the recent job gains across all of these different demographic groups. But what I think is really interesting to point out here is that the job gains themselves have also been disproportionate. So overall, about 55% of the job losses were among white employees, and they have gained about 63% of the jobs back, whereas for Blacks and African Americans, they lost 13% of jobs and have only gained 8% back in May and June. And for Asians, those numbers, the losses in March and April were 7%. The gains were 3% for May and June. And for Hispanics, they've actually fared quite equally. In both March and April, they lost 23% of the jobs and gained 23% of the jobs in May and June. So you can see that Blacks especially have been affected much more amongst all these other racial groups and have not been able to claw their way back from the job losses that they saw in March and April. So hopefully, this will continue to see progress as we reopen the economy. But as, we see setbacks with reclosures, we might see this sort of yo-yo effect and labor market trends, and especially for certain demographic groups. And, Gad, you were talking about some of the wage inequality and impacts, and, that brings to mind how, there was some progress made in terms of decreasing poverty rates for some of these groups. Can you talk about what should we expect in terms of wage inequality and poverty in the next month or so, or in the coming months?
Yeah, I think in the 3 to 5 years prior to COVID, we saw an actually decline in wage inequality. In general, in recent decades, one of the most noticeable trends in the US economy was the widening of wage gaps and wage inequality. But in the last 3 to 5 years before COVID, we saw a bit of a reversal there again because of the labor shortages for blue collar and manual services workers. But now we're probably, because the people at the lower end of the income distribution seem to be more affected by a COVID crisis, the economic crisis, but also the health crisis, we are likely to see this reversal. We expect wage inequality to increase again and poverty rates to increase again. For Black and Hispanic people, poverty rates reached an all-time low right before, in 2019, right before COVID. And now we unfortunately likely to see more poverty in the US, especially for Black and Hispanic people.
Yeah, and this sort of phenomenon or dynamic happened after the Great Recession as well. And even though the economy started to bounce back a couple of years after that, it really took some of these groups 8 or 9 years before they saw those improvements in unemployment rates and rising wages. So even though some segments of the labor market or certain demographics will see that improvement sooner, it'll take others much longer to get to that point. And that's what we saw with Blacks, especially. It was just in the last couple of years that they really started to see the gains of that last historic expansion in the economy. Frank, do you have any thoughts about that? Or
No, I think you already covered a lot.
Mm-hmm.
And most of the important trends here. Yeah.
Yeah, and a lot of it too with supporting some of these demographic groups are the minimum wage increases that we've seen in recent years, especially in 2020. 2020 was the year of minimum wage increases across jurisdictions, both state and local. There was just a historic amount of increases in the bottom wage that employers could give their employees. So that's really affecting the labor market right now too, and what employers are seeing in terms of labor costs. Gad, can you talk a little bit about how is the minimum wage going to impact what employers are seeing right now?
Yeah, so I think in recent years we've seen many states significantly raise their minimum wages, and it seemed not to have a huge impact on the labor market, partly because due to the labor shortages at the lower end, even market wages were going up very rapidly. But now we have a contrast. We have minimum wages continuing to go up in many states, but market wages are probably going to go down or stop going up at all for the people at the lower end. So the minimum wage is going to be more binding for companies. There will be more and more jobs where the market rates are well below the minimum wages, and it could have an impact on more automation of jobs at around the minimum wage, or perhaps even in some types of industries. Employers who are desperate in this time to cut labor costs will consider shifting operations into states and localities that have lower minimum wages, which we haven't seen much in the past, but that may happen at this point.
And the minimum wage is, part of a support that at least local governments can provide workers. But we're really seeing government relief measures at the federal level that have been particularly impactful during this time of crisis. And of course, we had those direct stimulus payments to individuals that were enacted back in March, and how we've been seeing those payments come through throughout April and March as well, April and May. But there was one survey, actually, the Civic Science survey, that noted that amongst those employees or workers that were not working or that had reduced hours, they had used that stimulus money really to purchase necessities, to pay down debt or bills, and many had saved it. And in fact, we're seeing record levels of a savings rate in the U.S., about 33%, I imagine, right? I believe. So it's really, people are feeling a lot of anxiety about their personal finances, and they're saving that money for that rainy day ahead. We don't know what's going to happen to the pandemic, and people are feeling that in their pocketbooks. The expanded unemployment insurance benefits has also been a huge boost to workers. The federal CARES Act provided an extra $600 a week on top of state weekly benefits. They also extended those benefits for an extra 13 weeks on top of the typical 26 weeks that those workers would get those unemployment benefits. It also expanded the eligibility, so independent contractors, gig workers, and the self-employed were also eligible for uninsurance payments. But even though there's all this support going out, even now states are still digging themselves out of this backlog of, after seeing historically high unemployment claims, many state systems are still overwhelmed. Some states in particular, like Florida, Kentucky, have had a hard time really keeping up with the number of unemployment claims. And much of that is also due to the outdated systems that many of these states have. They're very cumbersome to navigate. We heard lots of reports of systems online crashing and workers not being able to submit their claims, or having to submit their claims 1 week after another in order to finally get into the system. So it's really been, there's a lot of support system out there, but some workers have not been able to access it. But for those who have, the unemployment benefits in some cases represent more money that they are earning, more than they would have if they were to continue working. So the average worker in more than half of the states is collecting more from unemployment than from their prior job. We also have the Paycheck Protection Program, which is essentially a job retention program that is providing loans for small businesses, especially so that they would avoid layoffs. But a lot of those requirements for that program to retain their staff are incompatible with these generous unemployment insurance benefits. So if workers are actually earning more by staying home, having to go back, or employers calling them back to their jobs, they may not want to go back to do that. So, and if they do so, then they no longer qualify for that unemployment insurance. So it's causing some, rethinking of those relationships between employers and employees. And, it's making it difficult for employers to try to reopen or rehire workers when it may be in the best interest of workers, or at least they believe so, to continue to receive those unemployment insurance benefits. So that's sort of the lay of the land in terms of how the government has really been reacting to, how we're supporting these workers and benefits. And there's more of a fiscal cliff that we're going to see at the end of this month. So these unemployment insurance benefits do run out on July 30th. And, we'll see how that really impacts workers. If they're able to go back to work at that point, it might not be such a cliff for them. But if not, and that support runs out, we may see unemployment rates continue to climb as workers are forced to start looking for work again. And, we can see the labor market continue to deteriorate. Frank and Gad, do you have any thoughts about, what we can expect in the months ahead overall with the labor market?
In the labor market in general.
Any closing thoughts? Anything to leave our listeners
I
with?
think, unfortunately, I think we are shifting into a reality where it is very difficult to go back to a normal economy and control the spread of the virus at the same time. And something's got to give, and probably there will be a more restrictive economy in the second half of 2020, which means less economic activity, especially in those industries that are sensitive to social distancing. And it will be the 90% economy as opposed to the 100% economy for the next several quarters, I'm afraid.
Great. Well, thank you so much, Gad and Frank. I think we're going to stop there, and we've really dug into the June's jobs report and gotten some insights as to how are different workers in this economy faring right now amid the pandemic. And thank you all for listening as well. Please join us next month for our U.S. labor markets roundup, where we're going to be discussing the July jobs report and another special topic on the labor market. If you've enjoyed this podcast, please subscribe to Indications. You can find this program and several others from the Conference Board on your website. Just search for the word podcasts, or you can find them on your favorite podcast app. Thank you again for listening. I'm Elizabeth Crofoot with the Conference Board.
This has been Indications from the Conference Board.